Welcome to Tony Byrne's View with news you can use. Tony has over 32 years of experience as a chartered financial planner and wealth manager. Tony's passion is to help you retire early and live the life of your dreams with no financial worries. Now to today's episode.
Why dividends matter and share prices don't when you need income. When you're about to retire and you're going to rely on income from your investments and pensions, that's when you are most concerned about something known as sequencing risk. Sequencing risk being the risk that the order and timing of your investment returns are unfavourable, resulting in less money for your retirement. This can occur, for example, if there is a large stock market crash shortly after you have started taking an income from your portfolio. However, the reality is that if you are relying on the natural income from your investments and you are mostly invested in shares, you have very little to worry about as long as your time horizon is at least 10 years. Why do I believe this? Well, the reality is that the income from shares, the dividends, fluctuates very little annually, especially in the UK and the US. Dividends tend to rise each year, whereas share prices can be very volatile. In fact, apart from the years 2008 and 2020, dividends from UK shares have risen virtually every year for the last few decades. The dividend payouts are remarkably consistent. And if you can imagine a line on a graph that just year after year just steadily rises with just the odd blip here and there, then you'll know what I mean. On the other hand, the valuation of shares has varied greatly over the same period of time. For example, we experienced large stock market falls on Black Monday in October 1987. In the period 2000 to 2002, the end of the dot-com bubble. In 2008, the Great Financial Crisis, and again in March 2020, the start of the coronavirus pandemic. Large stock market falls of typically 30% or more have occurred on these occasions. Dividends have pretty much continued to rise inexorably, apart from the two blips mentioned earlier in 2008 and 2020, after which dividends resumed their annual growth. You can imagine a graph where you've got a zigzaggy line, but in an upward direction, and the zigzags are quite pronounced at time. That gives you the visual image of what happens when there is a crash in share prices, very different to that graph of dividend growth, which shows a very steady upward progression, like going up a hill gradually, and you just got the odd blip here and there where there's a bit of a fall, but not very much. So the message is very clear that the level of income from dividends is far more consistent, reliable, and less volatile than the share prices of the companies that actually pay them. So why does this matter? Well, the reason why it matters so much is because once you're aware of this fact, you really shouldn't worry at all about what is going to happen to share prices in the short term. Why? Because if share prices fall markedly, it is still likely that dividends will continue to rise. Dividends can only rise annually if the company's earnings, in other words profits, rise every year too. Guess what? In the long run, share prices will rise relative to the increase in earnings of the companies involved, i.e. profits. In the short term, share prices may get out of sync. But the general rule remains that share prices do reflect the earnings increases of the companies annually. So in other words, even if share prices fall in the short term, it is A, likely that dividends will continue to rise, and B, that share prices will recover as long as you are invested in companies whose earnings increase annually. So what's the current dividend yield from the FTSE 100 share index? Well, it's just under 3% currently, but over the last 5 years it has averaged about 4%. The reason for the temporary dip is because a number of companies reduced their dividends last year due to coronavirus, and some of these reductions were enforced by the government on certain sectors, for example, banks. So I've got a graph in front of me showing the dividend yield on the FTSE 100 share index, in other words, income as a percentage of the value of the shares. And as I stated just now, the average is about 4%. But it just taken a few figures at random. There are years here between 2015 and 2020 where we've had gains as high of the stock market as high as 19.17% and falls of as much as 12.99%. When you compare that to the dividend yield, in other words, the natural income from these shares, which have all hovered between 3 and 4% each year, then you'll understand the point I'm making here, that share price volatility can be quite high. But does it really matter if you know that the income being paid out by these companies, which comes from the profits that they make, and is pretty steady, they're under pressure to increase their dividends every year by shareholders. If you understand that the volatility of the share price is short-term, fluctuating up and down, but what really matters is the natural income, the dividends you receive from these shares. And if you're in retirement, really, what does it matter if share prices rise and fall? It's not something to get worried about, because it's just like the waves of the sea. A wave will go up, it will come down again. Just accept it's an inevitable feature of investing in shares. So knowing this, you should be emboldened to invest your retirement funds into the market, knowing there is a fairly high degree of probability that your natural income from dividends will continue to rise regardless of share price fluctuations in the short term. The key is to ensure that you have a well-managed, diversified portfolio in order to reduce the investment risk and increase the likelihood of you achieving a rising income throughout your retirement. So the message is not to worry about short-term fluctuations in share prices. Timing the market doesn't work anyway. Instead, invest your money and watch those dividends and your resultant retirement income grow. You know it makes sense.
Thank you for listening to today's episode. If you enjoyed it, don't forget to share it with your friends and family. For more information, head to www.wealthandtax.co.uk.